Welcome to the Dorsey Report. Thanks for joining me. You can read more at Google Sites, StockTwits, and Twitter. Today's report is for February 2nd, 2015. We're going to be going over the last week in review, looking at the week ahead, key things to keep an eye on, check out our leading risk indicators, look at why the US dollar may be at risk, take a review of the relative assets, how they're doing. And for our premium subscribers, we'll take a look at the S&P 500 action, look at the C-suite status, and look at a few stocks we've been keeping an eye on. And as always, if you like what you see here, please like, share, and subscribe to my channel. Thanks. Alright, so for our previous week, a nice little summary courtesy of Barry Holtz over at The Big Picture. On the upside, we saw jobless claims fall quite significantly. However, lowest since 2000. That's not really something I like to see for U.S. markets. It's always good to keep an eye on those analogs for the specific years and what was going on. As we know, the tech bubble may have been reaching its bursting point in 2000. But we'll see. That's just one analog. Apple had an amazing quarter, huge growth rates, 50% plus. Definitely one of the best looking companies out there right now in terms of their fundamentals. Personal consumption up, Chicago PMI beat, and big indicator here, U of Mich consumer confidence came in a little bit below expectations, but it was up from 93.6 in December, rose up to 98.1, so we know that's a big coincident indicator with the S&P 500. So as long as it keeps going up, generally a positive sign. One caveat, however, on jobless claims is that while they may be falling for most of the country, they are definitely rising and breaking out here for the shale states, Texas, Colorado, North Dakota, Pennsylvania, and West Virginia. And so it looks like the oil price crash is finally starting to bite. So it's always important to look at those leading markets and maybe take the aggregate numbers with a grain of salt. And our negatives for last week. U.S. quarter Q4 GDP did miss 2.6% versus 3%, so it does look like the U.S. economy as a whole is starting to slow down a bit. Durable goods were down. S&P 500 has had back-to-back losing months now, although the analog of 2012 isn't so significant. And yields continue to plunge, so again, kind of a connection to the deflationary signals that we're getting from bond markets globally. People continue to bid bonds. However, those falling yields and falling key commodities like copper and oil are not good global macroeconomic signs. Also, Dallas Fed had manufacturing come in at a negative, and pending home sales were down 3.7% month over month. This is typically the slow season for housing. You'll see prices and activity bottom out in January, February, and usually hit their highs and peaks during the summer, June, July. So again, a grain of salt with that. Kind of an interesting analog that's here is Germany, Europe's largest economy, did fall slightly month over month. However, it's the first negative print since 2009, and we know that 2009 was a significant bottom for at least U.S. markets. So it could be a potential contrarian indicator there. Yes, of course, the tech companies. We saw Microsoft, Qualcomm, and if we take a slightly bigger look over here at the largest U.S. tech sector by market caps, we see that a lot of U.S. tech stocks have just been really slammed. Microsoft down 14% last week, 14% on the month. Oracle down over 7% on the month. Intel down over 10% on the month. Qualcomm down almost 17% on the month. And SAP also getting hit pretty hard. We have a few companies that have done okay in China and 2 Japanese companies. But as far as U.S. tech is concerned, definitely some major weakness, and so that is a leading sector. That's something to be concerned about for the U.S. economy, and that's probably why we're seeing over here on our relative basis chart comparing the French CAC 40 against the NASDAQ Composite. We've had this massive rally and breakout above all moving averages. We do have an actual convergence here. However, with that RSI strength, there's really no reason that this ratio won't continue to rally to the upside to the benefit of the Euro and French economies and to the detriment of the US economy and tech sector specifically. So that's definitely a trend to keep a close eye on. As far as the week ahead, we should be keeping a close eye on the ISM manufacturing PMI on Monday. It's expected to come in at 54.5, which looks like an actual drop, but we'll see how that actually comes in. We also have ADP non-farm employment change on Wednesday and non-manufacturing PMI also on Wednesday. And we wrap up the week on Friday with non-farm payrolls and the unemployment rate. And as you've probably already noticed, we have a slew of Fed speakers. Bullard on Tuesday, Agriculture Lakota. Also Mester on Wednesday, Rosengren and just Rosengren on Thursday, and then Lockhart on Friday. So it looks like the Feds have the complete week after Monday covered, so they can finely tune the market's response to what may be deteriorating numbers in the other macroeconomic reports. In terms of our leading risk indicators, we have seen this end of January volatility downside that was expected with the Eurodollar COT. We are seeing a bounce basically throughout February, and then looks like some kind of a break mid-March. Seeing maybe potentially another a little bit of a short-term high here in the first week of February based on the commercial spec smart money positioning. But then the lows from that should come in the second week of February, and we should see a rally into at least mid-March based on that indicator. As far as our China 7-day rate, we are well off the highs back in January. However, we are above moving averages still for the longer durations, and we've turned up and are starting to make a higher high here. So it looks like whatever money stress is being indicated by China's commercial markets are still there, and ideally we would like to see this rate drop from being in the 4% area down into the lower 3% area to really get that all clear signal. An interesting aspect of the crushing of the oil market last year is the fact that something like a third of that was due just to appreciation in the US dollar. Tom McCullen has an interesting study he just released looking at the effective federal funds rate and how sort of the conventional wisdom that moves in that rate are coincident with the US dollar itself, because money basically flows to where it's treated the best. So the rationale is that if rates are higher, then money will flow into that currency, versus lower rates, money will leave that currency. However, from McCullen's research, it seems that there's actually a 3-year lag in that effect. And so you'll see that these appear coincident, the dollar and the effective federal funds rate. However, this fund rate has already been shifted forward 3 years. And looking at basically the completely flat dead behavior of the Fed funds rate basically all of 3 years ago is basically telling us that this rally in the dollar over the last year has actually been an anomaly, and we should definitely see some type of retracement fairly quickly to get resynced up with that trend. And Tom's got sort of an interesting reflection on this. How the media are hyping up the U.S. economy right now, and the U.S. dollar should be strong because of that. But in reality, the real employment numbers, such as the participation, labor force participation rates, benefits, part-time versus actual full-time jobs, all of those numbers really are deteriorating. And now that we have these falling oil prices, that's also going to definitely hurt U.S. GDP. And we see things like the initial claims in very oil-dependent states are starting to really spike. So it's clear that things are starting to sort of unravel at the seams, but it could be several more quarters before it's apparent that the entire U.S. economy is really starting to slide into a recession. So keep an eye out there in the second half of the year, because things could definitely be turning south. All right, in terms of relative assets, volatility continues to be king. as well as the gold miners. US long bonds and gold aren't doing too badly. Apple has had a very nice breakout. However, we really want to see it take out its previous highs just below 120 to basically start scaling in, Jesse Livermore style. That would be just a classic pyramid on a breakout from highs. So that recent pullback on Friday was not so good, but 120 is going to be the key level to watch for a potential breakout in Apple. In terms of what's providing the most value and strength right now, it does look like gold is only up 6% on the quarter, so there's some potential value there if it continues to rally. Also, somehow U.S. aggregate bonds are also starting to get into a strong place and are providing some potential value there. On the weak underperforming side, basically everything on this page is fair game for shorts. We've got U.S. small caps, the S&P 500, industrials, technology, energy, the transports, agriculture, and U.S. financials. The assets on this page that I would probably avoid trying to short, however, would be U.S. energy. It's already down almost 12% on the quarter. Russia down almost 29% on the quarter. And also the agricultural commodities ETF is down over, nearly 11% on the quarter. So while those are weak, they're not necessarily going to give you as big of a move as some of these other assets like, say, Disney, which is basically the services sector, pretty much, in the U.S., or the U.S. small caps. So keep an eye on those. And keeping with our theme of money going where it's treated the best, Jeff Gundlach is weighing in on this topic and saying that it looks like because of the latest round of ECB easing and the lowered interest rates in Spain, France, but throughout the Eurozone, money is going to continue to flow into U.S. bonds. And if we take a quick look at the total commitment of traders over here on the U.S. 10-year treasuries, but this is the TLT, so it's not necessarily a completely correct comparison, but they're close enough. It does look like we hit a downside extreme, which typically marks out significant lows, and we're just now beginning a rally. So there's plenty of upside on the COT before the bond markets are truly overheated and worth selling. Thanks for watching the Dorsey Report, and until next week, good hunting.